Hello everybody, welcome to TraderMerlin Show. It is your Thursday afternoon edition. Thank you all for joining us, and as Brendan says, I trust that everybody had a splendid session out there. Hello Tom, Brendan, Jeff, we got Terry with us, Jonathan as well, Raj, Ellen, Richard, Vernon, Jerry, big group today, love it, Dana, Les from Cape Canaveral, and Alex, my regular fixture now from NorCal, and Steve Hall. Good to have you guys all with us today. And yes, I do agree with the comment, the picture of our guest today, Tom says, I call fake. Yeah, well, I got the topic is market momentum with Bob Dunn. As you can see, Bob just tearing it up here on that wave. Of course, Bob wishes he had a physique like that. No, this is a little bit different. Bob was a goalie, and he does belong in a crease, not a curl. I don't know, Mr. Dunn, welcome to the show, by the way. And are you a surfer, too? I know Chicago's got such splendid waves. Do you surf at all?
Yeah. You know, actually, you guys make fun of that, but Chicago actually does have waves because we have a very large lake, Lake Michigan. And, of course, we don't get waves like you get in California at times. But
we call those ripples.
We could get more than a ripple over here. I mean, Lake Michigan's a pretty big lake. And as far as you can see, it looks like an ocean because you can't see the other side. So we kind of get the same effect other than the weather. But no, so as far as surfing, yeah, I'm a surfer, but I surf a different type of wave. We're talking surfing the markets.
There you go. That was the reference I was going with, the visual there. When you did the original one, which you kind of explained more of your methodology last year sometime, I had a wave of money, which is a little bit more appropriate. But anyway, I wanted to... it's riding market momentum. I figured why not have a surf wave out there. So how you been, Bob? How's 2021 treating you so far?
Oh, it's treating me great. Best year so far. Not really the best
you
year.
got 2 weeks in, man. I love the optimism.
It's the best week so far of the month.
There you go.
Of the year.
Well, you got a 50-50 chance of getting that right because last week and this week.
Right.
You know, one of the things, I know you have an upcoming signature series for Online Trading Academy, so maybe I want to talk a little bit about your strategy, which you call riding the wave, and then maybe we can look at some examples, because I know that you've always got trades going on, and we could talk about some of the other projects you're working on. Of course, if viewers have questions, and I see NJ Chelsea Football Club wants to know about Lowe's, CGC, and ACI, we can look at some of those as well. Tell me a little bit about your signature series and your kind of the premise behind what you're teaching in this riding the wave strategy.
Okay. What I'm doing in the signature series is I'm taking the trading floor. Well, that's how I adapted from the trading floor to the electronic market. I was a technical trader. I looked at the charts. I mean, primarily a technical trader. I would do other types of trading, scalping, when the market's really hopping. But, for the most part, I'm a technical trader, and I do what the charts tell me to do. So when we went from the trading floor, from the open outcry pits to the electronic market, there were a lot of traders on that floor that left, and they were like fish out of water because they weren't technical traders, and many of them weren't. They traded off of a certain feel, and you're able to kind of catch the momentum of where it's going, and the markets would trend, and they would trend nicely, and if you could catch some of these little waves, these guys would do well, but they traded off of a certain feel. Whereas I look at the charts, and the transition to the electronic market was real easy for me. Now, the mentality on the trading floor, for one, was I like to trade against the retail customer, because the retail customer is, one, so involved. And I'm not a short-term trader as far as looking at the charts. Many people trade on short-term charts. I've just, since I started trading on the floor, that was in 1981, and I walked off the trading floor in about 2006. And I've never looked at any chart less than a daily chart. I didn't know they existed, and neither did the people that I learned from. And that's not saying that money's not made looking at, shorter time frames than that. It was just, that's what we looked at. So my, can't teach an old dog new tricks. And so since I'm so used to looking at daily charts, I'm looking for certain types of moves. Now, let me just go back a little bit, because I mentioned before that, I like to trade against the retail customer. because the way they trade, again, apparently, they're looking at shorter time frames and they're trying to micromanage that trade. I'm not into micromanaging. I'm into letting things kind of move a little bit. In order to trade on the large time frame charts, this is why there's a whole group of people that trade on short time frames, and I'm sure they do well. And then there's people that trade on the larger time frames, and I'm sure they do well. But the difference is, on the larger time frames, it's a lot less work, and you're going to have a lot less trades that you're going to find. So the trades that we do find, they better be good ones. I might only make one trade today, so it better be enough to make my day, whatever my daily goal is, in case I just make one trade. Now, how do you get these trades off of large time frame charts? Well, these charts are created from human emotions. Fear and greed are two of them. And they create patterns and formations on the charts. And because they're created from these human emotions, fear and greed, and all of us in this room was created from the same mold, so we all have the same emotions. We just look different. We're created from the same mold. We just look a little different. But the emotions are the same. And we're going to create patterns on these charts. Now, these patterns repeat, and I'm looking for just certain select patterns or chart formations that I know are higher probability. They work a good percentage of the time. And when they don't work, you know where you're wrong because we're using precise entries. So I'm doing these on longer time frame charts. I cannot micromanage the trade, and I can't look at every single swing up and every swing down. And if I'm looking at a 1 minute chart or a 5 minute chart, the bars are changing from red to green and green to red, and they're, my emotions inside me are going crazy, and I'm micromanaging. I'm looking for trades where I don't have to micromanage. I know how they work when they work. I have a stop in to protect me so when I'm wrong, I don't get killed. And I am trying to catch momentum one way or another, and I just need the momentum for the day.
Right.
And so I'm trying to catch the trend du jour. And if it looks like it could continue on going at the end of the day, I'm going to reevaluate that, and I might hold it a little bit longer. But basically, I'm looking for the trend of the day on something that looks like it's going to move. Now, I mentioned these chart formations. Let's just take one, I look at about 20 different chart formations, maybe 25, that they're etched in my brain and I'm looking for them. Now, the charts that I look at are monthly, weekly, and daily charts. Now, to me, a chart is a chart. And because we're trading price and not time, it doesn't matter what time frame I'm looking at or that I'm taking the trade off of, because I'm trading a particular price. So let's just take, for example, there's a formation called a shooting star.
Yes, I love it.
And based on that formation, Merlin, you know that on the next day, if we go below the low of the shooting star, there's your trigger to get short. So if we have a shooting star on a daily chart, and let's just say the low is, I'm just looking at a low here, I'm looking at the Australian dollar. Let's pretend we're talking about the S&Ps. Let's say the low of that shooting star is
let's look at, I got one for you, Bob. Let's look at JP Morgan, JPM. Okay, so JP Morgan, of course, guys, comes out with earnings tomorrow morning, so you want to stay away from that one. But the daily chart of this is very close to a good shooting star. Unfortunately, the body's a little bit high up, but that pattern, after a long uptrend on JPM on the daily chart, that's a little bit of a shooting star. So maybe we can use that as a reference example.
Okay, so we'll use that as the reference. Now, for this to be a shooting star, I'd like to see the wick on top a little bit longer.
Yep.
But let's just pretend that's a good shooting star. We need to be short below the low of that, which I see is coming in at $140. Okay, so that means at $139.90, 95 cents, I got to be looking to get short. And where do I know I'm wrong? I know I'm wrong above that number. So that's a precise number. I got to be short below 140, and I've got to be out somewhere above it. Now, let's just pretend we see this same exact formation, and it happens to be on a monthly chart. that low of that shooting star is still $140, which means if we're taking the trade based on these emotions and we're looking at that monthly chart and the low of that shooting star is telling me it's $140, that means, because we're trading price, not time, that means I have to be short below 140 and I have to be out above it. And I know I'm taking the trade on the monthly chart, so in my head, I'm thinking I might have to be holding this trade a little bit longer. But that's fine. If you want to take the trade and close it out at the end of the day because you made your goal on that monthly chart and you saw a shooting star, you can take the trade at the end of the day. Now let's do the math, because I like to be the cheetah and sit in the weeds and wait for the right setup to come along. We talked about a shooting star.
Yep.
The opposite of a shooting star would be a hammer bottom, and then there's a whole bunch more trades. So let's just say I have 20 setups that I look at regularly. I've got 17 markets that I trade. 17 markets times 3 different time frames is what? 52, 51. 17 times 3 different time frames, just with one setup.
Yep.
I've got 51 possibilities of making a trade today. Now take 51 and multiply that by 17. Oh, no, that's 17 times 3. That's 51 on one setup. Now 51, and if you take 51 and you multiply that by, what did I say,
I need to develop a spreadsheet for you, buddy. You're throwing all kinds of numbers at me right now.
Well, what I'm saying is, if I've got 20 setups and I've got 51 possibilities of seeing a trade on 17 different markets, what's 17? What's 21 times 50? 20 times 51.
This is 102. 1,020.
That's your possibilities today or every day of finding a trade. Now, it doesn't mean that you're going to see a trade.
Yeah.
Because those formations have to happen. But if you've got 20 different setups that you're looking at, and you've got 17 different markets that you're looking for them on, if you don't see it in crude oil, you'll find it in gold. If I don't see it in gold, I'll see it in the Canadian dollar. If I don't see one of those setups in the Canadian dollar, I'll find it in the Mexican peso, or I'll see it in live cattle. But I have so many chances to see one of those many formations on 3 different time frames that if I don't find the trade today, I will find one tomorrow, and it'll make up for the money that I didn't make today. And can I lose? Of course I could lose, and I lose plenty. But when you catch these momentum trades on the bigger picture, the larger time frame, the moves are generally bigger than you're going to find on the shorter time frames. And all I need to do is search out these diamonds in the rough. And that's all I'm doing is searching for these. I search for these things, and I find them, and I trade them like a machine. I have people that follow me, and you see them on Twitter, and they're posting stuff regularly, and they're live trades. And these guys are becoming machines, some of them. And they have a Discord group that's dedicated just to this class, where they, help each other out and answer questions, and there's a lot going on in there, and I'm all about momentum and counter momentum. If I could catch this whole room long and I could see a reversal pattern that it's going to get me short before everyone gets in, I'm all over it. That's what I'm all about. That's what this class is all about, finding those diamonds in the rough and learning how to look at the charts and pick things out right away.
One of the things that I want to clear some stuff up here. So Bob's looking at a bunch of different pattern formations. And guys, on this show in particular, I've covered some of my personal favorites, which are, I'm sure Bob will say the same thing, hammers and shooting stars, which, those are simple ones we can easily find a filter for. Others might be, harami formations, and those are candlestick specific. Or as we looked at on the show the other day, ascending, descending triangles or cup and handles. All of these are telling us just a simple story of the battle between buyers and sellers, period. Now, I found it interesting, and I wanted to add my 2 cents to this one. Bob is saying, look, I'm not looking at any chart under a daily time frame. And that would almost instinctively make everybody in the room think that Bob is a day trader. Or sorry, a longer term trader, because he's smallest time frames a daily. A day trader should be looking at 5-minute charts, 15 minutes, hourlies, 4-hour time frames. And Bob's saying, I'm not looking at any of that. But you notice what he mentioned there is he's looking for trades that are going to last a day. So he's using kind of longer term time frames of monthly, weekly, and daily analysis on the charts and the patterns, setting those up as day trades when the conditions for the entry are met. And if by the end of that day or that period of time that he's looking to be in it, it still looks good, that day trade may now extend on to become a swing or maybe even a position trade based off that momentum. And that in tune to me is the ride the wave piece that he's mentioning. And I wanted to bring that up because I think some of you might have heard that and thought, well, this has got to be wrong. He's not looking at anything under a daily time frame, but he's saying he's looking for trades that last a day. It's just the follow through of these patterns is what Bob is looking for, and there's many of them out there. I've covered some of my personal favorites here, but I wanted to cover that just because it may have been a bit confusing to some of you. Now let me go through a couple questions. Okanola asked, what does he trade? And someone said he trades just futures. Bob trades more than just futures, right?
Well, I trade stocks, but I don't really follow stocks too much anymore right now because I'm involved with a trading group where the family, they're not allowed to trade any longer futures because of their son being involved with the CME group, and he's on the investigative side of the CME group. Mm-hmm. So he has access to what's going on his computers. He could see what Morgan Stanley and Goldman Sachs is doing. And so because he has that access, no one in his family is allowed to trade futures anymore, and that's how this family made their money. So I've become the designated futures trader for them and the whole group, and we have a group of people. So that's what I do. I don't follow stocks too much anymore. That's my buddy's job, mm-hmm. who does this. My job is to follow the futures. So I am a futures trader. I trade currency futures. I trade agricultural products and the energy products. So I trade everything that's traded on the CME floor and the Board of Trade floor, and of course the NYMEX and the COMEX. Those are the products that I trade. I'm used to trading those products because they were on the trading floor. When I was down there, I was trading the meats and all that. So I trade everything. And again, a chart is a chart. It doesn't matter if I make $500 today trading live cattle or if I make it trading the Canadian dollar. I could care less how I make it as long as I make it. And I'm looking again just for those diamonds in the rough, because I'm tired of going into the pit every day and beating my head against the wall, trading in and out and in and out and trading and scalping and spreading. And, spreading was fun because that was almost free money. But, just the scalping and all that was, it was a lot of work. It was very physical, and I just saw an easier way to do it. I was exposed to some of the best traders on this planet. Some of them were down on that trading floor, and I became friends with some of them. And you see these guys do what they do, and you ask questions, and then you understand what they're doing and why they're doing it. And after a while, you see them doing it over and over again. Certain things get kind of drilled into your head, and especially when you get yelled at by one of them for doing something stupid. Right. Well, the only reason why they yell at you is because you were obviously friendly with them.
Is that what it was? Yelling at people is a sign of friendship? This whole time, people have been yelling at me, and I thought they were just being rude.
Well, when I'm picking someone's brains for a period of time, and then all of a sudden you do something that's dumb and contrary to what they said, and they happen to be there witnessing it, you kind of get yelled at, but it's not like a yell. It's more of a little dig, and they're, just kind of giving it to you a little bit. Uh-huh. And, but, and these are the people that I've learned stuff from, and I got to tell you, I know firsthand guys like Richard Dennis do not look at anything less than a daily chart, because we never had access to. I mean, we did. There were computers around, but it was just daily charts. When you bought the book, there was a magazine called Commodity Perspective. It came out every week, and it listed everything that was on the trading floor. The first 2 contract months, they were all daily charts. So, no one ever knew to trade on less than a daily chart, and I didn't see a reason.
Yeah.
And no one ever showed me anything less than a daily chart, so I didn't know anything. And I could see why. When you're on those 5-minute charts and stuff, you're doing a lot more micromanaging, and you're doing a lot more sitting in front of the monitor and watching your trade. When I'm looking at the larger time frame, I'm seeing a bigger picture, and I could see, well, right now we're in the middle, in an uptrend. We're in the middle of this little zone here, and if we come to the top of the level of the zone, there's my target, let's just say, and you could see that there's money to be made on that particular move. When you're on the smaller time frame, there's a lot more obstacles in the way. There's more supply zones, let's say, above you. Mm-hmm. You're on a 5-minute chart, you might find 5 or 6 little supply zones where you might stall at, and you might stall there for a moment or so.
Yeah.
But when you're looking at the bigger picture, those supply zones aren't there. So you don't see those little obstacles that may be in front of you, and I visualize more dollars. I visualize a good trade. Whether it turns out to be a good trade, that's another story. But I can visually see this looks like it could be a good trade. Mm-hmm. And that's what I'm looking for. Just give me one of those a day, and sometimes you get 3 or 4.
Yeah. Let me, unfortunately you won't be able to see this, Bob, but I just, as you were talking, I drew this example for, who's the gentleman here that asked about this one? Alan G. He says, how much more reliable are patterns on a monthly versus weekly versus daily versus smaller time frames? Alan, it's challenging because you can't, I don't think it's a question of reliability. To me, a pattern, and the example I'm going to show you here is a descending triangle. It's kind of what I showed you the other day on the program. If you see it on a weekly time frame, great. You can expect a much bigger move. If you see it on a daily time frame, great. It's still going to have the same basic reaction, right? It's the same behavioral psychology of the buyers and sellers lining up. And here's the picture. So let's say you see this time frame here, and I just quickly drew this. It's hard to do the show and draw the stuff live at the same time. But notice this chart. Let's say this is a weekly time frame that we're looking at. You guys can see this descending triangle, and its peak there was $20. Its base was $10. So you get this $10 range. This is a huge descending triangle. When and if this thing breaks, you can expect a pretty large move. It's not going to move like 10 cents. It should move, $5, $10 from here. But would you say that this pattern here, this pattern here is the same? Notice it's exactly the same picture. I literally copied and pasted. It's this tiny little descending triangle. And let's say that's what you see on the hourly chart. Well, its base to peak is only $1 there, where the weekly base to peak was $10. So it's not a question of reliability. It's saying that if this thing breaks on that smaller time frame, how much am I going to get out of it? Am I going to get 20 cents? Well, if that's the case, you better have some serious size, way bigger position size. On the weekly time frames or bigger time frames, you can trade smaller shares or contracts or lots because you're expecting there to be a much bigger move. So to me, it's not about reliability per se. It's more about what's the expected move based off that pattern. And, a hammer formation on a 5-minute to me works fine. Hammer to me on an hourly works fine. Hammer to me on a daily, weekly, monthly works fine. But what's your expectation of that move out? The smaller time frame, the smaller you're going to see the move out, a reaction from those candles or chart patterns. So anyway, wanted to just draw that out there and hopefully add some clarity. Alan says, but takes longer to see returns. Yes, and that's a trade-off, right? I mean, Bob, if you're looking at weekly time frames and you're looking for the ride the wave that could last weeks to months, yeah, you're going to be waiting a bit longer potentially. Whereas someone who's short-term, you're getting your action at the end of the day or by the end of the day. So it's always this trade-off of risk versus reward of the different styles.
But here's the little catch to the way I do it. See, if I'm doing it on the monthly chart, in my head, I'm looking just to make my goal today.
Right.
So, just because I'm taking it on a monthly chart doesn't mean I'm going to stick with this trade for a month. The nature of my trading style and the way I move my stops around There's no way I'm going to hold that trade for more than 4 days, 5 days tops, and I could count the 4 and 5 days on one hand that I've held a trade, that's not spread. Usually I'm stopped out of these trades in anywhere between 1 and 3 days. Mm-hmm. So I can never hold a trade taken on a monthly chart for a whole month. When the market was selling off during COVID, it was so whippy the way it was whipping around, I had wide stops, but, they were still getting hit, and, you get stopped out. You can't hold the trades that long.
Yeah.
So, or at least I can't. The way, a guy like Richard Dennis, yeah, he could. Yeah. But I don't take as wild as swings, as big as swings as he does. And I'm just really going for a day-to-day thing. If the trade happens to go another 2 days or 3, I'll try to stay with it. It's a little easier now than it was back then, staying with these trades, because monitoring them is a little easier now than it was back then.
Yeah.
But it's just a matter, I'm looking at a chart as a chart, whether it's daily, weekly, or monthly. And each one of those charts I'm looking at, my intentions are just to pull my daily go out today, and it's basically a day trade.
Right.
And that's all I'm looking at. And again, I have so many possibilities because I'm looking at each chart as just a number, because I'm trading price. And just so happens now that shooting star, let's just say, happens to be on the weekly chart, and it's about to go below that low. And if I could pull $500 out of today, it might make a $2,500 move in the week. But if I could pull $500 out of it today, I'm a happy camper.
Yeah. There's a good comment here. In general, so Brendan says, it's an interesting one. It says, day trading, regardless of how good you are, equals more fees and more losses. Not necessarily. More fees for sure, because your transaction amount's going to be much higher. As a whole, I would say that more people lose money as day traders because they don't know what they're doing, and a lot of retail guys are in there. But it's not the domain of retail traders. I mean, you look at what the predominance on the floors out in Chicago, they were day traders, right? Those guys were trying to be flat at the end of the day. So I know a lot of people aspire to be day traders, but I wouldn't totally badmouth it as saying it's terrible. Some of the best traders out there in the world are day traders. They're just out by the end of the day, but they have the money to move these markets. Retail day traders, though, generally don't have stop losses. They're trading way too big a share size. They're trading the most volatile stuff, and those are the people that usually end up being statistics as failures in trading.
Right. I'm going to say 90% of the people on the trading floor that were successful, were out of their trades at the end of the day.
Right.
Most of them. There are a few that would take positions, hold positions, because, a lot happens. It's not like it was now, or it is now, where when the market closes at 5, it reopens at 6. Back then, when the currencies closed at 120, 120 they closed. When they closed at 120, that was it.
Yep.
Day's over. If you're not out of that trade at 120, you're waiting until 7:30 at 7:20 in the morning. I take it back. It wasn't 120. It was 2 o'clock they closed. I don't know why I was thinking 120. They opened it at 7:20. So if you weren't out at 2 o'clock of the currencies, you're stuck in there until 7:20 in the morning.
Right.
It's different now. You can manage the trades a little different. It's a little easier. But I'm still a day trader at heart, where I'm in the morning, or trying to initiate my trade sometime during the day, and give me my money and let me go home.
Yeah.
That's pretty much how I am.
Let me ask you, this is a question that came through from a couple different people asking about stop losses on this. Let me make sure I get that question. It was from Raj. It says, Bob, how big is your stop loss as you are trading off the larger time frames? And I think that what's happening is people are instinctively thinking that if it's a shooting star, you're going off the top of the tail on that shooting star. How are you establishing your stop losses on these things?
Well, you know what? I was taught, again, by one of the more famous traders around, never take a big loss. He said, I'd rather have 100 small losses than a couple big ones. And the big ones, he said, destroy your mental account.
Yep.
They don't allow you to get back into the trade. So let's just go back to talking about trading price and not time. Whether I'm taking the trade off of a daily chart, weekly chart, or monthly chart, and let's just use the S&Ps for example. My number in my head that I want to take risk on is with the S&Ps is approximately $125 to $150 per contract. So I will risk let's just say $150 taking that shooting star on the daily chart. Where does your stop go? If you're looking at a shooting star, your stop really, according to the books, goes above the high of the shooting star, above the wick. Well, that's all fine and dandy if this is a stock and, it goes above the wick and it's costing you $225 on your 100 shares. It's not like it's a big loss. But when you're trading something like the S&Ps and I get short on a daily chart below that low and my stop is above the wick, that could be a $900 stop.
Right.
On a weekly chart or a monthly chart, it could be a $4,000 stop. I'm not risking $4,000. So again, I trade each of those as if it's a chart, and I don't look at the time frame, although I know what time frame it is, but I'm looking at it as a number right now that's telling me be short below 37.10. So when it's below 37.10, whether it's a daily, weekly, or monthly chart, I use the same risk, $125, $150, because if I'm on a monthly chart and it goes below and gets me short and then pops back above, I'm going to stop out. People say, well, you're going to get stopped out more because monthly chart's a lot more volatile than a daily chart. Think again. Put up your screen, put a daily chart, a weekly chart, and a monthly chart, and put your matrix, your trading matrix, right next to that. Watch the bids and the offers going up and down on your matrix. They're moving at the same rate on the monthly chart as they're moving on the 5-minute chart. So the volatility is no different on a monthly chart than it is on a 5-minute chart. People think you have to risk that much more. Not if you're a cheap trader like me. I'm getting short because there's a reason to get short, and then I get out of that trade when that reason doesn't exist anymore. I'm not going to wait $3,000 to go, well, I don't think that trade's working. I better get out.
Let me draw the picture here for this, Bob, because it actually piggybacks perfectly on the graphic I just put up here. So, guys, to draw that example in, Bob is what we would call a confirmation trader. He's identifying a setup, and he's saying, once price confirms it's doing what I believe it's going to do based off this price, then I'm going to go and react. So you guys remember the other day, I was doing it the opposite is. We were doing an ascending triangle. Here is a descending triangle. And what Bob's saying is, look, I feel like it's going to be breaking to the south side here. I can just see it's making lower highs, lower highs, lower highs, but the bottom is staying the same on this descending triangle. So when it breaks, let's say it gets below this $10 mark, which is the bottom of it, as soon as it does that, let's say $9.95, $9.99, I'm going to go short this one. And I'm basing this off the probability that selling pressure is still going to be there. It's going down. If it all of a sudden rips back up and stops him out for a small loss, he's going to take that small loss. So to me, that's the establishing of the stop loss. It's not saying I'm going to go to the top of this triangle way up here for my stop loss. It's saying he's got a specific dollar amount for him, which I think is a great way to do it. It certainly doesn't ever get to the point where you're feeling absolutely horrible because you had a losing trade of a couple $100. If you had a stop loss all the way up here at the high, that could be several $1,000s. So he's a breakout trader. Again, this could be a hammer, a shooting star, whatever cup and handle pattern you want, but he's waiting for it to confirm by doing what he thinks that pattern is going to do, which in this case is going to be going down. If it's ascending triangle, it's going up. If it's a shooting star, it's going down. So it's just reaction. Once the pattern does what it's supposed to do, then he jumps on it. And if he's wrong, he'll take a small loss, but he should, more often than not, get some follow through here and have a nice trade. Anyway.
That's exactly.
Start at the short price or finish at the shorter price? I'm not sure I understand the question there, Alex. He says start at the short price or shorter price. Basically, I have this second line drawn here, so if I'm doing live editing on PowerPoint, which is probably not the easiest thing to do. Let me delete that line and this line. So basically, you'd be looking at this one here. That's the chart formation for that specific trade. What else do I want to ask you? You mentioned a couple things here. The Monday, Wednesday, monthly, weekly, daily. What you mentioned some patterns. I'm kind of curious to see what some of those are because I have a lot that I like to look at. If you had to say your top 5, what are your top 5 ones that you like to look for?
Top 5 what?
Patterns.
The formations?
Yeah.
Well, there's individual candle formations, such as we were talking about the shooting stars or hammer bottoms, but there's also clusters of formations that you find on the charts, such that require, 30 or, 20, 30, or 40 candlestick patterns, such as, head and shoulder tops or head and shoulder bottoms, those ascending and descending triangles that you're talking about. They're fairly predictable, and I'm all about the precise entries, as you said before, or confirmation entries. When you're doing a confirmation entry, it's based on pretty much a precise number, a level. And I like precise because that tells you exactly where you're right, but you don't know how right you're going to be on this trade. It could be a nice run, or it could just be mediocre. But you know exactly where you're wrong, and that's the good thing. Because when we're trading, especially when we're trading a leveraged product like futures, where it could take away every single dime you have and more, and we don't want to let that ever happen. So when I'm trading something like that, I have to know how much I'm going to risk on this trade. Right. I have to know. And I'm trading, when you're trading zones, this is why I don't like to trade zones, with the distal and proximal lines. I'll use a distal line, and I'll have my proximal line based on what I want to risk on the trade. Because if I do a proximal line the way, you probably should do the proximal line, do it on a weekly chart and watch your risk be $2,800 on one contract. I can't do that. So I find my risk right away. I do all my analysis the same way from time frame to time frame, but I just use the distal line. So I have a more precise level. I love confirmation entries. I don't mind getting in with market orders. I'm giving up a one tick edge to get in with the market order because I don't care about one tick. Yeah. One tick is the cost of doing business for me. It's a business expense. Right. And I'm trying to make 80 ticks, where if I make 79 or 80, I'm having a good day. I'm fine.
Yep. It's also important that the ones that you're trading have ample liquidity because, you start getting something liquid, you're not getting a one-tick spread. It could be much more than that.
You need liquidity. I mean, someone was asking me the other day about cotton. And, it's not that liquid. I mean, I think it trades on a high day, 26,000 contracts, and it can be traded, but, I'm not a big trader of ICE products. I don't even have a feed for any of the ICE because I have enough activity going on in the other products. But we definitely need liquidity. You don't really need a lot of liquidity when you're entering the trade. I mean, if you're trading multiple contracts. But when the market turns on you, and you got to bail out and you want to bail out quick, you need liquidity. And that's when it really dries up, when the market turns. So, as Merlin said, we want to trade liquid. And I found that, there's about 17 real good liquid products, really good to trade, listed on the CME, in the CME group. And, there's more out there. It's just, I've got 17 good ones.
You got plenty, yeah.
And if I don't see a setup on one of those, I'll see another setup on another one. I'll find something somewhere today to trade, and if I don't, I don't.
Is there anything right now that you're looking at? Maybe we can use as examples or something that's hot off the presses that you think might be noteworthy?
Well, pull up the Australian dollar.
Futures or spot?
Futures.
Okay. Man, that weekly is just gorgeous.
Well, you look at the weekly, and it's just hot. If you draw a line off the bottoms from July and all the way to now, it's a nice trend line that we're holding, and we're going to be following that line up. We should be following that line up, and it just looks like it's going to go. If you look at the daily chart, it had a little minor trend line that was formed today. It was holding the lows this morning, and I was able to make a couple touches on the line where it's real nice. I'm trying to look into it now, and it looks like it still wants to go higher. I just that was one of the things that I was looking at only because of this weekly chart. Yeah. This weekly line. I'm actually sitting in the weeds waiting for it to break below it.
Okay.
Because it's oversold or it's overbought on the daily, weekly, and monthly charts, and it's it's ripe for a sell-off. I'm not saying it's happening because it might just keep going up and up and up and up. I always talk about have an opinion, just don't stick to it. Because when you get married to your opinion, the divorce becomes very costly. So,
well, that sounds like there's some experience behind that one. Trust me, I know it too, Bob. I know that one very well.
Yeah, so you don't want to get married to that opinion. And so right now, I'm like I said, I'm sitting in the weeds on this, and I'm waiting. And this is going to, and every week, that line that I drew in becomes higher and higher and higher. So it's catching up to price. And, eventually, and I'm going to guess, eventually it'll go below that line and I'll have a selling opportunity. Will I be able to make $500 on the first day? Maybe. Maybe it, goes below that line and gives you $1,000 right away. Maybe it goes below that line and then turns around and stops you out.
Yep.
But you know where you're wrong when it stops you out. You're wrong somewhere above that line, but I don't know how right I'm going to be, but I have an idea because I draw in my levels below that line where I think it's going to go, my targets, because I associate everything with surfing. And if I'm catching a wave below that line, if we go below that line and the GPS in my head goes redirecting, turn right at the next intersection, and the intersection is that line, I'm looking for the next place that I think this is going to stop. And I'm not looking for it on a 15-minute chart because I'm going to find too many intermediate places where it may bounce off of and take me out of the trade.
Right.
I don't see those little bounces. I'm focused on a bigger move because I have to make a lot of money on some trades. And the reason why is what happens if I have a $500 a day goal, and I lose 200, I want to make 100,000 a year. That's going to be $500 a day will give you about 106,000 a year.
Right.
So I want to make 100 grand a year. So I got to make 500 a day. Well, if I lose $250 today because it wasn't such a good day, most people will come into work tomorrow and figure, well, it's time to make 500 bucks. Well, that's not the case because if I want to make 100,000 a year, I got to make 500 a day. I lost $250 yesterday. So today I have to make $1,250.
Yep.
I have to make $250 for the money I lost, $500 for the money I didn't make on Monday,
right.
And then I have to make $500 for today, Tuesday. And that's how it is. So if you lose $250 today and you don't show up to work tomorrow because you didn't feel good, well, then you got to make $1,750 the next day just to stay on track. So I need big winners.
Right.
I can't afford to take trades on smaller time frames. They don't give me, like you said before, smaller time frames, smaller profits. Larger time frames, larger profits. It's all relative. Mm-hmm. Well, I need those larger profits because even on the smaller time frames, it's easy to lose $250.
Sure.
So, now I gotta make $1,250 tomorrow. I got to look at the big picture. And that's, really what I teach. I teach is how to look at the big picture. How did I survive for so many years, never looking at anything less than a daily chart? And, well, that's how I know. That's all I know is to look at daily charts or higher. And that's what goes on in this class. And if you read a lot of the tweets that are sent to me, a lot of the students say, you have opened my eyes with the small time frames. I will never look at them again, because it makes you married to the screen, and you've got a 24-hour job pretty much. If you're going to be staring at 15-minute charts or 5-minute charts, you're glued to the screen. You can only take breaks to go to the bathroom, and you're right back in front of the screen.
Yeah. Wait, you mean? Bob, I have what do they call it, a John? With a little, it's like right here in my seat is actually a toilet, so I save time that way.
Oh yeah, you do. Or you could be like me. I used to bring my computer into the bathroom sometimes.
Oh boy, don't be borrowing your laptop.
Leave the camera on. Yeah, that could be gross.
Oh, wow.
But no, you don't want to be glued to that screen. No. You got to have a life, and you'll see. You can get a life. There is actually a life in trading. And and it's more relaxing. I've seen
That's
too many
definitely
guys walk into the pit, buy 80 contracts at the market, walk out, and you see them coming back 5 hours later, and they're selling those things and making a ridiculous amount of money, but whether they bought 1, 5, or 80, they bought them and walked out.
Right.
They weren't looking at the market going up and down, up and down, up and down like I am. As I'm standing in the pit, not leaving, I'm hearing every single bid and offer going in. It's like I'm standing inside of a pit, inside of a tick chart.
Sure. Well, I think, Brendan said something here that's interesting, and I want to repeat this because for anybody who's been watching this show or watching me on Power Trading Radio for the past decade, I talk about this quite a lot, which was, where was it? Brendan says, you have to adapt your trading style to your personality, asset base, and lifestyle. And, one thing is, I tell everyone to take the Big 5 personality test. You can do it for free online, and it'll tell you a little bit about your personality. If you're a very impatient person, then day trading is going to be where you gravitate to organically because it's faster paced. It's always moving. I agree with Bob that the bigger picture generally yields the biggest trades, best results, etc., and it's a lot less stress. But some people do find that they love that short-term stuff. Just know it's going to be stressful. You're going to make a lot of trades, and it's going to be stressful. I'm going to say that twice because short-term intraday stuff, very, very, very stressful.
Well, think about this too. Every single time you open up a brand new trade, you're putting yourself at brand new risk because there's an unknown on every time you open up a trade. So the more trades you make, we got to just be profitable at 30%, and we could be 30% right, and we could be profitable. You got to just know how to let these things run.
Sure.
But I lost my total train of thought.
Yeah, but you're on a roll. We got to wrap it up here, but let me ask you one real quick question, which is a hot one. And I know that you were very active, but Brendan, who's always asking every guest I have, what's your thoughts on crypto? Are you in it?
Cryptos? Yes. Well, I think we talked last year. I talked to you. I said I was loading up on Litecoins and buying them and buying them. And yeah, I've been playing around with Bitcoin and Litecoin. But Litecoin, I just kept buying and buying and buying and, not looking at them. And then all of a sudden this thing's taking off.
Thank you for driving the price up, Bob. I appreciate that.
Well, if you take a look at them now, they softened a little bit, but they're starting to pick up somewhat.
Yeah.
They're coming back. I mean, it's not like they had a huge sell-off, but it was a nice sell-off from there, which needed. It was brought up on, Alan Greenspan would call this irrational exuberance. And that's what was happening with, there's too much of a spike up on there. There was too much money being made in Bitcoin that there had to be some type of profit taken somewhere. Yep. And we witnessed it this past month when Bitcoin opened up right around where it closed the past month. It opened up at 38,925, made a high of 40,365, but then it sold off and closed at 39,605. Well, it sold off to 31,000. So, it had a huge sell-off.
Yep.
Not huge, but it had a
huge.
good profit-taking sell-off. For a lot of people that got in there, made some good money, but there's also a lot of people that jumped on the bandwagon and watched it, waited for a pullback, and said, I don't think this is pulling back. I'm going to buy it here at 39,000. And those people got their butts kicked a little bit.
Well, not much. It's back to 39 right now, so.
No, I'm just saying on the way down.
Sure.
Feeling.
It was for me. I saw it as a buying opportunity, so I bought some of that most recent sell-off. We'll see. I'm definitely much more of a long-term hold. All right. So when's your class? When's this signature series you're doing?
I have one coming up in I think 2 weeks, and I have another one in February. I had to remember what month this is now.
It all blends together when we're quarantined.
It is. I mean, I'm like doing nothing. My highlight of the day is going to Costco. And I get paranoid in that place a little bit just being around the people.
Dude, even before COVID, I was paranoid in Costco. Man, I get trampled in those things. All right, guys. Bob Dunn's been our guest today. If you want to know more information, you can go to TradingAcademy.com's website. He does have a signature series. I do believe they're running a special on the signature series right now. There is actually, I think, 5 or 6 instructors. You have Sean Reed doing one talking about peddling premium. You have Bashir Chaya doing one on futures. You have... who else we got? Bob Dunn doing one on riding the wave. You have, David Warner doing one on Forex. You have one on Bill Addis doing one on bonds. So there's a whole series right now, signature series, where these guys are showing kind of their ins and outs ways of doing things. So if you're interested, go to TradingAcademy.com. You can find out more information about that. Bob, thank you so much for coming on. I appreciate it. I'm going to try to get you on more frequently. And glad to have you. Yeah, I'm always glad to have you back on, man. So thank you so much, and I hope you stay nice and stay warm out there. As I was rubbing it into Bob earlier that it's 83 degrees here in California right now, and he's in 40s. So
I'm in the 40s. Yeah, it'll be in the 30s tomorrow.
Yeah.
No, actually, I think we're gonna have some rain tomorrow, but then we'll have snow afterwards.
What's that?
It's the white stuff that you see on TV sometimes floating out of the sky and dropping on the ground everywhere, and people can make little figures with round balls.
Oh yeah, I saw that documentary. That was about Pablo Escobar, right?
Yeah, exactly.
All right, Bob.
Round balls.
Perfect. All right, buddy. Hey, thank you so much. Appreciate you coming on. Have a great signature series, and hopefully I'll talk to you soon.
All right, thank you, Merlin.
All right,
thank you, everybody.
Guys, that was Bob Dunn, many years on the floor out there in Chicago. It always fascinates me on how he just does not like those short-term time frames. But you look at his style, his methodology, it makes total sense. And I agree with him. I think the bigger time frames are less stressful. You tend to get much bigger moves. What he's done, in my opinion, is kind of create a hybrid of it. He's basically saying, I'm going to use the bigger picture to make the bigger moves, but I'm also going to have very short, small stop losses. And, if you went back and looked at his, I haven't seen it, but I'm pretty sure based off the methodology that he's going to have way more stop losses than he does victories, stop outs than victories. And that's not a bad thing. If somebody told you that they had a 30% success rate on their trading, you probably think that's absolutely horrible. But if the reward to risk ratio is like 10 to 1, I'll take that 30% success knowing I'm just hitting out of the park on 1 out of every 10 trades is a monster big one. So great. Anyway, hope you guys enjoyed that. Yeah, thumbs up, Brendan says. Hope you enjoyed that session. Let me go and show you what happened out there today and for tomorrow, because there is some important economic announcements. I have to go past my wonderful drawing over here. Sorry about that, but this is what you get for live stuff. Here's what happened. This is for tomorrow. So here's your economic calendar for tomorrow. You'll notice there is a ton of stuff. Friday, this is going to be a big day tomorrow. It's going to be actually a really big day. Why? Because first off, we have, a dozen announcements: retail sales, producer price index, Empire State Manufacturing Index, capacity utilization, industrial production, business inventories. I mean, holy cow, it is a huge list of stuff happening tomorrow. So be careful. Notice that most of this batch right here, I'm going to highlight in red with my wonderful crayon. That all happens before market opens. Actually, this one as well. And then 30 minutes in the market, we get these bottom 3 announcements. So be careful there. Here's what happened today with regards to earnings. Delta Airlines, they missed earnings expectations. No big deal, but it wasn't as bad. They reported $2.53 loss, and they were supposed to make a $2.43 loss. So it was 10 cents worse than expected, and they surged up 2.5% today. What was interesting was Afria, that was one that some of you guys are heavily in. They actually were supposed to lose 2 cents a share. They came out at break even. 100% surprise there. They were up 18%. And then BlackRock, starting off our earnings season for financial firms with a beat of earnings, but it wasn't well received. It was actually down 4.63% today, even though they beat by a good amount on their earnings. Now, here's why it's such an important day tomorrow. To me, this is the litmus test for earnings season, and generally it's mixed. We will see. We have JP Morgan, we have Citigroup, we have Wells Fargo, and then PNC Financial. These are all major financial firms reporting earnings tomorrow before market opens. So that's like how we'll start the day. If you look down there near the bottom, you see Carnival Corporation. They're supposed to report, but they haven't officially said they are. So every week it seems like Carnival is saying they're going to report. To me, it looks like they are just going to tank and continue to sink. All right, that will do it for your economic announcements and earnings announcements. As far as show for tomorrow, it's hard to believe that it's actually Friday already. So I am totally open to doing more of what you guys want me to talk about. So if there's specific topics you want me to cover on tomorrow's show, send it in sooner rather than later. You can actually go out to the email that I'm going to put on your screen right now, TraderMerlin@gmail.com, and send me a suggestion. If it's something that requires me to build a lot of stuff, it may not happen, but hopefully you guys have some ideas of things you want me to cover tomorrow, an analysis of specific securities. That's great. Bring it on. Let me know. I've got a listener show tomorrow. It's just going to be me, no guests, so I'm happy to take whatever questions and comments you guys have. Of course, hit that like button. If you want to know more about Bob Dunn, he's teaching a signature series for Online Trading Academy, which you can see at tradingacademy.com and find out more information there, or contact your local center. That said, man, that was a lot of stuff in that last run-on sentence I had right there. Anyway, hope you guys had a fantastic show. Hope you enjoyed Bob as much as I do. He's just such a great, interesting personality with a ton of stories. Hope you have a fantastic trading session out there tomorrow. Be careful. I expect a lot of volatility. I'll see you tomorrow. Take care.